Have you ever asked yourself what truly moves stocks? What is the long-term catalyst that will move a stock higher? Well, in this video, I'm going to talk about one of the main drivers of what moves stocks and how you can build your investment strategy around this particular move in markets. Just a heads up, this is not purely educational. This is not advice, so please do your own due diligence. Hey, if you like this video, please hit the like button, and if you would, subscribe and share it with a friend. I really appreciate your help and support on the channel. You know, they talk about whales, people, companies. In Las Vegas, they have a whales table for blackjack, poker, all that kind of stuff. These are people who bet so much big money, they're worth tailoring your business to, like we've seen in Vegas. Well, the same is in the markets. In a lot of cases, it's institutional traders, it's big hedge funds, companies who can really just drive the price of a stock. Well, one of the biggest whales in the markets are central banks. The Fed. These guys move money around the system and they create money flow. And they raise interest rates, they lower interest rates. They create great opportunities within markets for you and I. The trick is understanding what they're doing and when they do it, what areas will perform best. Over the last year, we have seen the big whale come into this market and present incredible opportunities for you and I to capitalize on growth. Back in March of 2020, the Fed came in with some of the biggest whale money you could ever imagine. Roughly $2 trillion came into the market, and they created liquidity into a system that was basically starting to seize up. And this is presented an incredible opportunity for all of us to capitalize on their big money move. What they did was they took all this money, they went out and started buying up treasuries. They started increasing their balance sheet. And as of today, roughly $4 trillion increase in their overall balance sheet to a balance of right under $8 trillion. 4 trillion of that came in the last, 13-14 months. So as they go out and buy at between 130 billion and 150 billion dollars a month right now in treasuries and mortgage-backed securities, they're inadvertently diluting the US dollar. And since March of last year, the dollar has fallen from $1.03 to under 90 cents on the dollar as of this morning. As you can tell, I have my dog with me. This is Indy, and she likes to sniff everything. We're out here in Colorado for the month, just hanging out, getting away from the heat of Florida and the tourism. And Indy is so enamored with everything that's going on here that she stops and smells everything, and it's driving my wife and I nuts. So as the Fed was printing money, as it's been said in the media, and they are, with their bond buying programs, or they're buying mortgage-backed securities, they're buying high-quality corporate bonds, and of course they're buying a ton of treasuries, and they're expanding their balance sheet. And then when they do this, they dilute the US dollar, which then causes inflation. Now, they won't say there is any inflation, and today's the 9th, tomorrow the CPI number comes out, and it'll probably be one of those like mind-blowing numbers because the cost of goods have all gone up. You've probably seen it in lumber, you've seen it in corn, copper, all your commodities. You've seen it in housing. Even though that we're starting to see housing mortgage applications drop, and we're starting to see new sales starting to drop because of the cost of money. But there are categories of the market or sectors of the market that have done exceptionally well since June of last year. A handful of those are, of course, the commodity market, the energy market, the copper and corn market. Go back and look at corn or the CRB index, and you'll see this thing since June of last year took off. And that's when the real printing of the money and the injection of that money into the market really started to skyrocket. Now the Fed's really got itself in a pickle, if you ask me. They want to keep interest rates low so they can keep the economy flowing and moving forward, but in doing so, they're also diluting the power of the dollar, and they're creating inflation. Now, of course, they'll come out and say, inflation's not that bad. It's really not that bad. But if you go to the grocery store or you go get gas, I went to the gas station the other day, and now I'm out here in Colorado, so gas prices are a little higher. I paid $4.20 for medium grade octane gas. Now back at home, that was in the mid $3 range. And as prices on oil go up and the cost of our dollar devalue, or the value of our dollar devalues, that number is going to increase overall and our buying power shrinks. So where's a great opportunity to invest in? Energy. Simply just taking a position in the energy index, and you can make money, and you have been if you've been playing this route since the beginning of the year or going back to June of 2020. The other area is infrastructure, industrials, that kind of thing. You're starting to see the money spending ideas from Washington to go out and spend money on infrastructure build out. This is helping propel that sector of the area, the products and goods and services that we use to build out infrastructure. Along with that is materials. That has done very well since June of last year. Along with, look at high yield debt, not, high grade corporate debt, but high yield debt. Debt that's more like junk bond stuff. These are all affected by that move in the big whale, that printing of the dollar. And I believe you're going to continue to see that happen until we start to see our economy in the US, like we're seeing in China, devalue or start to lose value or speed or momentum. You can see this in China's performance as an overall country. They're slowing down. They're entering that stage 3, that more stagflation type of environment. Whereas we are in more stage 2, more growth and rising inflation environment, and of course cheap money. And I think if the Fed gets its way, they're going to continue to keep money, dirt cheap, which will continue to drive the growth of the United States, but also drive the growth of inflation. And at some point, that growth and inflation come to a crossroads. And that's when growth starts to lose momentum and inflation starts to move higher at a higher rate of change. So how do you use this as an investment catalyst? How do you use this as a framework to capitalize on all this? This is where I think you need to get into the macro side of things. You start to look at what performs well in a rising inflation environment, high, volatile stocks, along with anti, bond type positions, so rising interest rate type positions, so tips, shorting the indexes or ETFs when it comes to bonds, along with financials. Financials have done incredibly well in a rising yield market, so rising treasury yield market, along with a devaluing US dollar market. Now, of course, all of this at some point stops. At some point, we cross that crossroads, and you're going to have to make some changes in your overall portfolio. And this is where you having a great investment philosophy or strategy you put in place that's really based on numbers, on rate of change, not this just feels good, or the guys on the Reddit channel are blowing up this stock and this, that, and the other. They're great for day trades. They're great for quick wins. But if you're looking for a long-term investment strategy with the majority of your money, this is where you build out a macro approach. So as a recap, what is the Fed doing today? Today they're printing money, devaluing the dollar. What correlates opposite of the dollar devaluing? Industrials, financials, materials, along with energy type related, commodity type related investments. That's your framework you start with. Then you find companies within it that you can invest in that are capitalizing on a devaluing dollar. When we see the Fed start to raise rates, then your game changes. What correlates opposite to a rising dollar, to rising interest rates? These are the things you're going to start looking for when you build out your macro model. This is Lake Granby. This is such a cool place. I'm very fortunate to have a friend who has a place up here, and I get to hang out here. Just want to say thanks to them if they're watching this video. This is so awesome. If you ever get a chance to come up to Lake Granby, you should do so.